Want to stick with the markets now, though, and bring in Octavio Marenzi. He is CEO at Opimas. Good to see you, as always, Octavio. So what do you make of what we're seeing in this bounce back in tech right now? Are you believing it? And how exposed are you to that sector?
Well, I think the bounce back is going to be a somewhat temporary phenomenon. So I think what's going to happen at some stage is the Fed is going to have to raise interest rates. We're seeing inflation pressures all over the place. We see it in consumer prices and producer prices. And at some stage, the Fed is going to have to raise interest rates. And that's going to be terrible for the tech market. Now, I don't expect that to happen in the next few months, but I do expect in the next half year or so that Jay Powell is going to have to bite the bullet and say inflation looks bad, is getting out of hand. We have to raise interest rates. And that's going to be terrible for the tech sector and for the markets in general, but particularly for tech. So I would expect to see a fairly large correction there, sort of towards the latter part then of 2021.
Well, let me ask, don't you think that the market has been pricing in higher interest rates later in the year, and that perhaps when it actually happens, the shock won't be so great?
I think you're right to a certain extent, but I think what we've seen so far is largely sort of almost homeopathic doses of corrections, as opposed to something that's really fully fledged and really a strong correction. And I think the correction is going to be much, much stronger when those interest rate rises do come. So yes, we've seen some trepidation, some hesitance over the course of the past few weeks in the tech sector, but nothing like what we see when the interest rates actually do get raised. But bear in mind, I think there's a large segment of the market that is basically betting that interest rates will never get raised, and that Jay Powell is going to be able to pull this off without ever having to increase interest rates, maybe even he'll lower them further, and some people are betting on that. But I think when the interest rates do come, a lot of people will be surprised, and it's going to be vicious. It's going to be really tough.
Octavio, I want to dig in a little bit more on that, because I think there's been a lot of talk and also a lot of debate on this point about the interest rates, what the Fed is going to do, and really more about when. So I hear what you're saying, that any kind of move, Jay Powell biting the bullet about interest rates, won't happen in the next couple of months. But do you see in your calculations the chance of that pivot increasingly happening sooner than the Fed has really indicated, or perhaps sooner than the Fed would even like?
Well, I mean, if you listen to the Fed's indication, Jay Powell has said quite clearly that he expects this uptick in inflation to be a very temporary phenomenon, and that it will come back down and will all be okay. Now, I don't know what kind of models Jay Powell is looking at. I do wish he'd share them with us to let us know exactly how he comes to those conclusions. I'm told there are some very good econometricians at the Fed, and they do genius things with numbers. But for some reason, he never shares those models with us. I'm not quite sure why that is. So he has some sort of model that tells him inflation's gone up a bit now, and it's going to come down, and then it's going to go sideways, and it's all going to be okay. I think what Jay Powell actually knows very, very well is that people's expectations about inflation influence inflation. So if we all expect, or if the majority of the market expects there to be strong inflation, there will be inflation. People will sell their money, they'll look for other things, they'll decrease the value of money, and that will happen quite quickly. So he's sort of trying to talk people down. He's aware of those sentiments, and he's basically trying to say, can I persuade people to adjust their expectations regarding inflation and bring it down? And I think that's the game that he's playing at the moment. But that is almost a bit disconcerting, because I think the market sort of knows, or many people know, that's what he's up to. So I don't think that's going to help him that much.
So then let's talk, allocation of portfolios for the investors that are watching. How should they approach their portfolios, given all that you are mentioning? Some folks have talked about that barbell approach. Some folks have talked about being evenly weighted in some of those growth names, and some of those value plays, cyclicals. How are you thinking that investors should be approaching their portfolios through the end of the year and beyond?
Well, so the timing of this is going to be very difficult to actually pull off accurately. So I'll be the first to admit the timing, exactly when interest rates do increase and the impact on the market, is going to be very, very swift. So as soon as people see that or start to think that's about to happen, markets will correct very, very quickly. So if you wait until the interest rate rises actually happen and then say, I'm going to get out of tech then, it's going to be too late probably, because everyone will be rushing for the doors at the same time. So the question is, how do you actually time that? And there's no really good answer to that, because if you sell now, you run the risk that you're going to miss a further spike in the prices and a further increase in the prices. So those are the things that you have to weigh off. I mean, for people who are really risk averse, I would say maybe now is the time to liquidate some of your portfolio in tech and look into other areas. I think sort of hard assets like gold are starting to really good again. I mean, gold has not had a fantastic year this year, but Bitcoin has suffered tremendously. And I think Bitcoin had stolen a lot of gold's thunder over the course of the past year or so, with a lot of people who are sort of inflation hawks or really looking to find an asset class that will protect them against inflation, moving out of gold and into Bitcoin. That seems to be reversed now again, and the money seems to be flowing back into gold. So I think gold is probably a pretty good bet to look at overall. So those are some of the sectors we're looking at. I think also the financial services sector, particularly sort of big investment banks, trading houses like Goldman Sachs and Morgan Stanley, they've historically done actually quite well in very choppy, volatile markets, particularly Goldman Sachs. So that's probably a stock worth looking at if you expect markets to start to misbehave a bit. They have historically done very, very well in those kind of market environments. So that's a stock worth watching. But as we get into this, I think it's interesting when we look at the monetary policy and what it's done to basically bank deposits. And I think that's another thing really worth bearing in mind, is that banks now, sort of your brick and mortar retail banks, are sitting on huge levels of deposits, larger than they've ever had before in the past. And they have not lent all that money out, and they've only lent out a fraction of that money. As the economy starts to recover, they're going to start to lend out that money to people. So we'll see, I think, a boom in the banking sector on a short-term basis as that starts to filter back into the economy. So I expect to see lending start to become very, very robust in the next 6 months. And eventually then they'll have to raise interest rates again at some stage later on this year.
And we know that, historically banks do quite well in an environment where there are rising interest rates. So Octavio Marenzi, CEO at Opimas, thanks so much for being with us.